Most traders spend months optimizing entries. But what if the real reason the strategy fails has nothing to do with the entry? What if you're simply trading the wrong market? That's why in this video we'll cover how to find the best market and time frame for your strategy. Most traders spend weeks or even months building strategies, optimizing parameters, testing indicators, and searching for the perfect entry. Yet very few stop and ask a much more important question first. Am I even trading the right market? That question can be easily answered by using Exploratory Data Analysis, or EDA. The idea behind it is simple. Find the market and time frame where your strategy is the best chance to work before you build anything on top of it. So before I develop a strategy or write a single line of code for a backtest, I run a market analysis first. I want to know whether the market itself has characteristics that actually support the type of strategy I plan to trade. For trend-following strategies, I want to know if the market truly trends. And what makes this even more interesting is that some of the results completely challenge my own assumptions. There was one market I always considered one of the strongest trend markets available, but once I analyzed the data, the results told a very different story. But we will get to that later. First, I want to address a mistake that happens over and over again. A trader sees a strategy on YouTube with an incredible equity curve, hundreds of % returns, and an impressive expectancy. They copy the rules and immediately start trading. But a strategy only works if it is applied to a market whose statistical properties align with the assumptions behind that strategy. A trend-following strategy needs a market that actually produces trends. A mean reversion strategy needs a market that frequently reverts back toward its average. If that foundation is missing, even the best strategy will struggle in the long run. Maybe EDA sounds complicated and scientific, but the idea is actually very simple. Before we test a strategy, we analyze the character of the market itself. However, there is another mistake that many people make during this stage. When you analyze a market, you should never use all available data. You should always split the data set into an in-sample period and an out-of-sample period. The in-sample data is used exclusively for analysis and hypothesis generation. The out-of-sample data remains completely untouched. The reason for this is simple. If I allow future information to influence my decisions, even indirectly, I introduce information leakage. That is exactly how many backtests end up looking incredible on historical data while failing completely in live trading. For this analysis, I remove the most recent 5 years entirely. Those years simply do not exist for my market selection process. I only analyze the 10 years before that. By doing this, I reduce data leakage and selection bias, making the results far more honest and far more reliable. But how do you actually measure the character of a market? This is where my scoring framework comes into play. It relies on many metrics, which are directly from quantitative research and have been publicly known for years. But the real value lies in how those metrics are combined, weighted, and interpreted. However, let's start with one of the most important metrics, the efficiency ratio. It answers a very simple question: how efficiently does a market move from point A to point B? Imagine two markets that both gain exactly 5% over the course of a week. The first market rises steadily and relatively smoothly. The second market constantly moves up and down before eventually ending the week at the same 5% gain. Even though both markets reach the same destination, the first market is far more attractive for a trend-following strategy. The efficiency ratio captures exactly that. It does not only evaluate direction, it evaluates the path taken to get there. Another key characteristic is trend persistence. I am not only interested in whether trends occur, I want to know how long they typically last. If a trend disappears after only 2 candles, it is not particularly useful for a trend trader. But if trends tend to persist for many bars, the probability increases that a trend-following strategy can actually exploit its statistical edge. That is why I measure things like the average length of trend phases and the percentage of bars that are genuinely part of a trend. Beyond that, additional characteristics also contribute to the overall evaluation. I look at the statistical distribution of returns, the persistence of the time series, and multiple robustness checks. Robustness is especially important to me because I do not want results that only work under one perfect configuration. I want to know whether the market still exhibits the same characteristics when I slightly change certain parameters. A robust market should not completely lose its identity just because a threshold changes a little. Once all these metrics are calculated, they are combined into a final score. And this is where things become really interesting. Most people would probably assume that the Nasdaq is obviously a strong trend market. I used to think exactly the same thing, but when I separated the data by time frame, the picture changed dramatically. On the 1-hour chart, the Nasdaq achieved one of the highest trend scores in the entire analysis. On the 4-hour chart, It was still among the strongest performers, but as the time frame became smaller, its character changed significantly. On the 30-minute chart, the score dropped noticeably. And on the 15-minute time frame, it was no longer exceptional. The strong trend characteristics that stood out on the higher time frames had largely disappeared. The market didn't change. The time frame did. And with it, the behavior you were measuring. And that is one of the most important lessons in this entire video. You were not simply trading the Nasdaq, you were trading the Nasdaq on a specific time frame. And that distinction often determines whether a strategy succeeds or fails over the long term. The same pattern appears in many other markets as well. Some currency pairs perform surprisingly well in higher time frames. Others lose almost all their trend characteristics as soon as you move to lower time frames. Knowing these differences beforehand can save countless hours of meaningless backtesting. Because why would I spend time developing a trend-following strategy for a market whose statistical properties do not even support trend following in the first place? If there is only one thing you take away from this video, let it be this. Do not blindly trust a guru. Do not blindly trust a backtest. And definitely do not assume that a market automatically fits your strategy.